Now, as we pivot more towards the consumer, we want to look at construction, because construction has been obviously a strong move from the lows of 2011. In August, construction spending, again, starting to roll. It came in at negative 0.7 versus the estimate of 0.3. The 2 consecutive monthly declines, again, it's the first since the pandemic started, and private construction was down 0.6, private residential was down 0.9, and private residential home improvement was up 1%. So again, that's where you're still seeing that slowdown is there. We're seeing that move down. We're seeing those different moves lower, but it's just starting, and that's the key piece when you look at the spending. It's, yes, all of this is happening, but we're still at the very early stages. So to see or say that, well, the Fed's going to have to pivot, it's like, well, where's the data that shows that they should pivot? Again, take away stock prices. We're not talking stock prices, which were already insane, because one of the things when we decided to launch the private equity fund in 2019, we had a true sit down. We're like, do we want to invest in and create more of a hedge fund and do your typical stocks? But we looked at the stocks and we're like, it's criminal. I mean, we wrote an article about it in terms of how the stock market is a circus. And when you look at it, and again, when you look at the guy from Barstool, just talking about how easy it is and picking tickers out of a bag, that's not investing. That's not, like, how absurd did we get? And now it's going to take time to get all of that liquidity out, to see that. So we are still in the very early stages of this adjustment to, again, bring things back to normal. So then when you look at U.S. healthcare costs, again, it's funny when you look at where the largest buyer and also we spend the most. So September marked the 4th consecutive month of declines in the U.S. in the used car price side. But then you still have the healthcare costs. And yes, like we've talked about how we're going to cut pricing. It's like, look, we're the largest buyer. You go to them and say, we're paying you 20% less. And if you don't like it, go somewhere else. But for some reason we have to get to that point. And then when you look at on the used car side and the car side, that's continuing to move down. But there's, again, a lot of that offset that we've been talking about and really honing in on. So then when you look at U.S. manufacturing sentiment versus the 30-year mortgage rate, there's that move lower. And when you look at just the 30-year, obviously it's inverted, so you can kind of see that drawdown. You have to look at just where the pressure is. And U.S. manufacturing sentiment versus the 30-year mortgage rate, again, pipelines, markets, economies, everything is getting just hit. And now, where is this headed, and what is the pressure? And one of the things that we've been talking about is that manufacturing is going to be the biggest decline, and it's just starting to really accelerate to the downside. But again, when you look at those job sides, look at job postings. So job postings on Indeed continue to drift lower. But again, this rate of decline is not fast. It's very slow, and you need to see some bigger step up. Now, when you look at job postings by occupation, remote work share, that high remote is coming down because a lot of those jobs may not be needed anymore, or they've already been filled, and the ones of low remote, medium remote still are hanging around, but people don't want to go to the office. And as they don't want to go to the office, they're competing more for the high remote and less for the other, and that's where you're going to have to see people start to adjust. But then when you pull back and look at the big picture, and I love this chart. I think this chart, it says so much. When you consider that, how much can you buy with a $2,500 monthly mortgage payment, assuming a 20% down payment, and the average 30-year mortgage rate? At the peak, it was $758,572 home. So you could buy a home that was over $750,000. Now it's $476,000, $476,425. You've lost almost $300,000 in value just based on where rates are going. And we're just getting started in terms of what some of this normalcy is. But people have to sellers have to recognize that you missed the top. You even missed before and after the top. You could have sold any time in 2020 and been in a great position in 2021 versus right now. And that's where you're starting to see some of those seller strikes, because they're like, well, I'm not selling excuse me, into this market. I'm not taking this risk. But again, that's where you're going to have to see some of those different pieces adjust. But when you look at job openings, you have to look at the potential labor force participation and look at the trend. Look at where we currently are. So yes, job openings are coming down, but we already didn't have enough people to fill that void. So now what? How are we going to close that gap? And that's where you're seeing a lot of this a continuous issue. The PMI composite versus corporate profits, you're seeing, again, that movement down when you look at where are corporate profits going, and that movement lower as we get that re-rate on the market in general overall. So now when you look at PCE inflation, still hot at 6.2% versus the estimate of 6%. This is a very key piece for the Fed. So 6.2% versus 6%. The core PCE was expected to be at 4.7%, came at 4.9%. So again, you're seeing that acceleration again. So yes, the JOLTS data was good. This, not so much. And that's where you're seeing that pushback, which is why the Fed is not in any near-term period going to pivot. Also, U.S. real personal consumption expenditures. They've rolled, but they're still elevated. Now, we think this accelerates to the downside in October, November, December, but you're still there. We're not in a dire place yet. We're not in this struggling spot. There's still more to go. And then when you look at since February of 2020, personal spending in nominal terms, blue, is up by 18%, but spending in real terms is only up 6%. So it's widening the gap, but real spending is still up 6%. Like, you're still higher. And when the consumer cracks, which is we think is now, like we're making the call that it is right now. The acceleration to the downside is happening. And this is one of those key pieces that I think the housing side is going to take that air out of people's sails, and that's where you see that bigger drop. Wage and salary growth is coming down alongside CPI, but the jump has been stronger than that of overall inflation and is still firmly in double-digit % territory, looking at the two-year average. And it just goes to show you how low wages were. Because even though on a 2-year % change, wages and salaries are higher, but yet real income is still negative because wages have been lagging so much. So even on this true up, you're still well off of where you should be with obviously inflation continuing to remain elevated. So when you look at the PC price index, you want to look at, services are going up, which is what we've been saying. Non-durable goods, some of those coming down, non-durable goods shrinking. And that's the piece. The services are going to still remain expensive while we see some of those movements lower. Subcomponent contributors to U.S. PCE continues to be obviously gasoline and other energy. Goods were down, but that, as we've been saying, with WTI at 88, diesel prices going higher, gasoline prices going higher, we see more of that upside coming. And that's when you turn to that real personal consumption expenditures, and where the services will continue to take a bigger bite, but the durable goods and those non-durable goods, we see that again shrinking and moving down and moving lower, especially with savings rate in August was unchanged at 3.5%, which is obviously incredibly low, and only the slightest tick down for government transfer payments. Share of personal income in August, high relative to history, but again, well off that peak. And then when you look at that personal income, came in at 0.3 versus the estimate of 0.3. Personal spending, 0.4 versus the estimate of 0.2. So again, it's just that movement down is, we think it picks up in September, but really starts to roll in that October into that end of year period. And then current auto inventories are above their 12-month average by 14%. And it's just, again, the cars are showing you things like housing is showing you some of those shifts that are continuing to adjust in the market. University of Michigan Consumer Sentiment Index bounced, but still very low. Current conditions bounced, but again, still very much in a depressed state. Personal savings as the disposable income is showing you why people feel that way. And then the savings drawdown now looks very rapid. And that's what we've been talking about, is everyone's been quoting numbers that were from Q2, but when you true it up, there's been an accelerating downside, and it's actually been trued up in terms of the mark to market, and they actually adjusted it. It is not as good as initially said. And again, this is the problem that we've been talking about, where the saving grace of savings isn't what it is expected to be, because inflation and costs have been so high. Now, Chicago PMI came firmly into contraction, expected to be at 51.8, came in at 45.7, which is a huge drop lower. And again, that's just showing you the direction in which that is going to continue to trend. And then when you turn to housing, payment to income ratio versus the 30-year, some of the worst it's been since the 80s. We don't see that changing. Pending sales is down 21% year over year. And one of the interesting pieces is, yes, there's 3 months of supply available on the market, but look at the new listings. New listings are down because people are like, I'm not selling to this. This is over. Like I'm not touching any of this. It's done. This is the way it's going to work. And I think that is one of the key pieces in general when you look at some of those buyer strikes, when you look at some of the underlying values. And then rounding it up for the leading indicator, mortgage purchase index from MBA mortgages fell by 12.6% last week, which is the worst drop since March of 2020, which again is that leading indicator as mortgage rates continue to go up. So that's what we have for you for the US. In the next segment, we're going to go deeper into Europe and things that are happening abroad.